that we are required to prepare. We have number one, a financial statement for banks. Number two, we have financial statement for insurance company. Number three, we have IFRS for SME. Then number four here, we have financial statement in hyperinflationary economy, hyperinflationary economy. Then lastly, number five, we have interim financial statements. These are the things we have to look at under financial statement for other entities. Therefore, today we want to begin with financial statement for banks. We begin with financial statement for banks so that we see how banks prepare their financial statement. Therefore, we say financial statement for banks. That is IAS 30. IAS 30, International Accounting Standard number 30. That is where we find how banks prepare their financial statements. Now, a financial statement of a bank is just like any other financial statement, except there are some different terminologies that maybe we are going to include that were not maybe in the other financial statements that we were preparing. Therefore, here, we want to look at financial statement for banks. We look at peculiar items. Let's look at the peculiar items. Peculiar items, these are items that are only found in banking institution. Number one, we have what we call cash balance with central bank. This is an asset to the bank, This one we report it as an asset to the banking institution. The bank is required just to hold a certain amount of money. Any extra cash that comes on top, you deposit it with the central bank. Therefore, that is an asset. Remember, it's an amount that you can take at any time. Number two, we have what we call deposit and placement with other banks, deposit and placement with other banks. This is also the money the bank is depositing with other bank. Therefore, we are going to report it as an asset. It's an asset to the bank. Number three, we have deposit and placement from other banks, deposit and placement with other banks. This is the money other banks have deposited in our bank. This is a liability to the bank because we need to remit to the bank. Therefore, number four item that is unique, we have what we call government securities. Government securities, this is also an asset to the bank. Of course, we shall be getting interest from there, which is our revenue, we shall be getting from there. Then number five, we have loans and advances. Loans and advances, these are just normal loans that the bank issues to customers. Therefore, this is also an asset and we get their interest income there. It's an asset to the bank. Therefore, we have it there. Then number six, we have what we call customer deposits. This is the money. If you have money lying idle in the bank, that is what we are saying customer deposits. But remember, in this regard, we are talking of the fixed deposit account, the money you fixed on you put on your fixed deposit, because we shall be getting that liability to the bank, and of course we shall be getting their interest expense, especially on a fixed deposit. When people come to fix their money in the bank, it becomes a liability in the bank, and of course the bank will be paying interest on it. Then number seven, we have provision for loss allowance. Provision for loss allowance. I remember very well when we are doing financial instrument, impairment of financial instrument, we mentioned loss allowance. Now, loss allowance is an expense to the bank. This is an expense you provide for, an expense you provide for as a bank, you provide for provision for loss allowance. And this one will be computed based on loans and advances, because whenever we give out loans as a bank, not all customers will honor their obligation. Not all of them will honor their obligation. Some will forfeit to pay. Therefore, we have to provide for the loss allowance. I remember when we are doing financial instruments, IFRS 9, we mentioned impairment, where we said that the bank is required to provide for a credit loss. And we said there are three-stage model for credit loss provision, where we said stage one. In stage one, we said that no sign of default has been shown, but as a bank, we just provide for. Then we have stage two, where we say that there is a small sign that this person will default. Then we have what we call stage three, where this person has defaulted completely. And I remember we did examples on those. Therefore, here we have provision for loss allowance there, provision for loss allowance. Then we have something we call off-balance sheet, off-balance sheet items in the bank, off-balance sheet. This is just for your information. Off-balance sheet in items, this is just for your information. We have what we call acceptance and letter of credit, number one. Acceptance and letter of credit, acceptance and letter of credit. Number two, we have commitment to lend, commitment to lend. Number three, we have forward contracts. Number three, we have forward contracts. We have forward contracts. Number four, we have what we call futures contracts. There. Then we have guarantees. Number five, what we call guarantees. Guarantees is whereby, for example, you want to do business, then you negotiate with the bank to guarantee you to supply goods to a customer, for example. There we have guarantees there. Therefore, those are some of the items that we shall be having in the banking institution that we do not see them in the normal financial statement. Therefore, these are some of the items like cash balance with the central bank, deposit and placement with other banks, deposit and placement from other banks, government securities, loans and advances, customer deposit, and provision for loss allowance. Therefore, without wasting time, a banking institution has nothing much. We just want to see how you prepare the income statement or profit or loss statement of a bank, because that is where we are going to begin. How do we prepare a financial statement of a bank? Then we move on to, we do a question, then we shall be done. We move on to do a question, then we are done. We move on to do a question, then we are done. Therefore, Therefore, let's look at the format on how you prepare income statement of a bank, because in a bank, we have some items that will be unique. There will be some items that will be unique, Therefore, we look at the format. We say XYZ bank, XYZ bank. We are assuming our bank is called XYZ. XYZ, we assume our bank is called XYZ, and XYZ bank, statement of profit and loss, statement of profit and loss, and other comprehensive income, other comprehensive incomes, Then you give me columns of currency, shillings in millions there. Shillings in millions. Out of this, we are going to look at the interest income. We look at the interest income. We start with our interest income there. Interest income, we are going to have, for example, interest from loans and advances. Interest from loans and advances, you put it there. That's the main revenue of a bank, loans and advances. For example, from customer loan, from government securities, there. We have deposit and placement with other banks, deposit and placement with other banks. The interest there, we are interested with the interest. Deposit and placement with other banks. We have other interest income. Sorry, this one we can put in the last column there. Let's put it in the last column. Let's arrange professionally. We put in the last column, not first. Put it in the last column kindly. Put it in the last column, not first column. We want to put it professionally so that here we get our gross interest. We get our gross interest there. Gross interest. Put it in the second column there. Then we come to less interest expense. We come to less interest expense. Where do we have interest expense? Interest expense will be coming from customer deposits. We have interest on deposit and placement from other banks. Deposit and placement from other banks. We have other interest expense. Then whatever we have here, we come and less from our gross income. We come and subtract from our gross income. We get our net interest income. We get our net interest income there. Then out of that, we come to add other incomes or operating incomes, operating incomes or other incomes or operating incomes there. My operating incomes here will be, operating incomes will be like, for example, fees and commissions, fees and commissions in our column here, last column, fees and commissions, foreign exchange gains, foreign exchange gains there, foreign exchange gains, that is non-interest income or other operating. We have dividend income, Then we come to other incomes, other operating incomes, Then we have total income. We have what we call total incomes. We have what we call total incomes. We have total incomes there. Now, out of total income, we come to less, operating expenses, These are normal expenses in a company, normal expenses in any company, like for example, staff cost. In the first column, you put in the first column, staff cost. We have, for example, stationery. We have stationery. Office expenses, depreciation there. Then we get our total expenses there. After we have total expenses, we get profit before tax. Profit before tax there. Profit before tax. We have what we call profit before tax. Profit before tax there. Too quickly. Profit before tax. Then after that, we are going to shift to, we come to less taxation. Yours is a continuation with less taxation. Under taxation, maybe we have a deferred tax. For example, we have deferred tax there. And also we have a current tax. When we less these two items, we get profit after tax. Just as any income statement, we get profit after tax there. Just like any other income statement, we get profit after tax. Then we come to less dividend. Dividend, we have what we call interim dividend, and also proposed dividend that we propose at the end of the year. Proposed dividend. Then we get retained earnings, profit for the year. We get profit for the year. There. After that, we come to add retained earnings brought down. Brought down is the one for the previous year, the profit of the previous year. Then we get what we call retained earnings. earnings carried down. Retained earnings carried down there. Retained earnings carried down. And that makes the end of our statement of profit and loss and other comprehensive income. Statement of profit and loss and other comprehensive income. Statement of profit and loss and other comprehensive incomes. That is how you prepare your profit or loss statement. Profit or loss statement of a bank. Any question before we go to serious questions there? Anything question before we go to serious questions there? Anything? Anything? If there is nothing, then let's go to the question of April 2022. April 2022, question number, I think 5 or what? Question 5 or what? April 2022, question number 5. Is it 5? Question 4, not 5. Question 4, sorry. Question 4, not 5. Question 4 of April 2022. Do quickly. When you are there, you say, yes, we are there, so that we move faster. When you are there, you say, yes, we are there. April 2022. Thank you very much, Ruth. We continue. It says, question number 4. The following information was extracted from the financial records of Belda Bank Limited as at that 1st March 2022. We have cash and balance with the central bank. We say that is an asset. Money on demand and short-term deposits, that is an asset of the bank. We have deposit with other commercial banks, that is an asset. Deposit from other commercial banks, that is a liability. Investment in government securities, that is an asset. Investment in equity instruments, that is an asset. Property, plant, and equipment, it's an asset. Intangible assets there. Loans and advances to customers, that is an asset to the bank. Customer deposits, that's a liability. Long-term borrowings, that is a liability. Other receivables, that is an asset. Other payables, that is a liability. Income tax paid, that is the tax we paid during the year. Deferred tax as at 1st April 2021. Interest on loans and advances to customers. Interest on government securities. Interest on loans on deposit with other banks. Interest on deposit from other banks. Interest on customer deposit. Interest on long-term borrowings. Administrative expenses. Other operating expenses. Fees, commission, and foreign exchange income. Ordinary share capital, that is equity. Share premium, that is equity. Deposit protection reserve, that is equity. Retained earnings, that is equity. Then lastly, we have suspense account. We have what we call suspense account. Additional information, where the devil lies in additional information. Additional information is saying like this. Additional information. It's saying like this. On 1st April 2021, Belda Bank Limited issued shillings 450 million 5-year 8% coupon bond at par. The bond will be redeemable at a substantial premium which gives it an effective interest rate of 12% per annum. There were no issue costs. The only accounting entries made were to record the cash proceeds from the issue and the annual interest payment on 31st March 2022. Number 2, as at 31st March 2022, the directors of Belda Bank Limited accepted evaluation report by professional valuer, which revealed the fair value of the property, plant, and equipment to be 2.5 million. The carrying amount of the property, plant, and equipment amounted to 1850 million. The directors do not wish to make an inter-reserve transfer upon the revaluation. However, they do account for deferred tax on revaluation of property, plant, and equipment. Revaluation is yet to be accounted for in the books of the bank. Number 3, during the year ended at 1st March 2022, the current tax on profits was estimated to be 890 million. As at that 1st March 2022, the carrying amount of the net assets exceeded their tax base by 1.8 million. These carrying amounts do not include the effect of revaluation in note number 2 above. The income tax rate applicable to Belda Bank Limited is 30%. Required statement of profit or loss and other comprehensive income for the year ended at 1st March 2022, 10 marks. Statement of financial position as at that 1st March 2022. Now, when you read note number 1, let's go to note number 1 and see. Let's read note number 1 and see. It says on 1st April 2021, Belda Bank Limited issued shillings 450 million 5-year 8% coupon bond at par. The bond will be redeemable at a substantial premium, which gives it an effective interest rate of 12% per annum. There were no issue costs. The only accounting entries made were to record the cash proceeds from the issue and the annual interest payment on that 1st March 2022. Now, what the examiner is saying there that we issued an instrument. If you remember very well, when you are doing financial instrument, when you issue an instrument, you are required to recognize there a finance cost. You recognize there a finance cost. At the same time, you recognize there the liability at the end of the year. There we are going in note number 1, we are going to recognize a finance cost as part of the interest because we issued a bond of 450 million. Therefore, if you issued a bond, remember how we were amortizing the bonds to get interest and also to get the liability at the end. That is what examiner wants you to do there. Number 2, as at that 1st March 2022, the directors of Belda Bank Limited accepted a valuation report by the professional valuer, which revalued the fair value of the property, plant, and equipment to be 2.5 million. The carrying amount of the property, plant, and equipment was 1850 million. Now, when you read in that note, it means that we revalued an asset. You remember in group accounts where we were doing fair value adjustment. The moment you revalue your asset, you are required to recognize revaluation. But if examiner is giving us this, he says revaluation is yet to be accounted in the books of the bank. It means we have not accounted for the revaluation. We have not accounted for the revaluation. Therefore, it means you are required to account for that revaluation. You are required to account for that revaluation. Then note number 3 is talking about tax. Tax, we discussed income taxes where we have temporal difference and deferred tax liability and assets. Therefore, quickly, let's implement this. Let's start with the income statement of this bank. Quickly, let's begin with the income statement of this bank. Let's do the income statement of this bank. And you will see that now you can enjoy FR. We say Belda Bank Limited, Belda Bank Limited, Belda Bank Limited, statement of profit or loss and other statement of profit or loss and other comprehensive income. Comprehensive income for the year ended 31st March 2022. You underline like that. You underline like that. Then you give me currency, shillings in millions. Shillings in millions. There are two columns of currency as we saw in the format. And as usual, this one we are going to begin with interest income. You begin with interest income. Now you just go to the trial balance and see what are your interests. Some interest will not be given directly. Others will be given directly. Like when you check in this question, examiner just gave us interest directly. Like when we go to item number 1, cash balance with central bank, we say that's an asset, it's not interest. Money on demand and short-term deposits, that is asset. Deposit with other banks, that is an asset. Deposit from other banks, that is a liability. Government securities, investment in equity, property, plant and equipment, intangible asset, loans and advances to customers, customer deposit, long-term borrowings, other receivables, other payables, installment tax paid, deferred tax, interest on loans and advances. We start with interest, loans and advances. Because we have written here interest income, we just say loans and advances. Loans and advances, it is 2575. In the last column, 2575. We have interest government securities. We just say government securities because we have written there up. Government securities 2264. 2264. We have deposit with other banks. Deposit with other banks. Deposit with other banks. That is 646. Deposit with other banks. That is 646. Then we go to interest deposit from other banks. That is interest expense. Customer deposit, interest on long-term borrowings. There you give me interest income, gross interest income. You give me gross interest income there. Gross interest income. $54.85. That is gross interest income. Then we come to less interest expense. We come to less interest expense. Interest expense, I'm taking them from the trial balance, where we have interest deposit from other banks. Deposit from other banks, 662. Customer deposit, 1833. 1833. Long-term borrowings. Long-term borrowings, 1385. Then administrative expense, that's other expenses. Now, when you read in note number 1, there is some other expense that we need to compute. Note number 1. There are some expenses that we need to compute. Note number 1. Note number 1. Finance cost. Finance cost, which is an interest expense. Finance cost. Note number 1. We have the nominal value. Nominal value of the bond, which is 450. Coupon payment, which equals to coupon payment 8%. Effective interest, which equals to 12%. Remember, this one we did in financial instrument, therefore there's no big deal. We did in financial instrument, therefore we are going to amortize. We say amortization schedule. Amortization schedule. We say here, principal balance, interest, installment, then balance carried down. Balance carried down there. Balance carried down there. We are only doing for 1 year. We are amortizing to get the finance cost and also to get the balance carried down. We have here 1. Principal balance is 450. Interest is 12%. Installment is the coupon payment, which is 8%. Which is 8%. Our interest 54% is 54. 12% is 54. Then this one is 36. The installment is 36. Therefore, 450 minus plus 468. 468 is the liability at the end. This will go to the balance sheet. This is what we have as finance cost, the interest, finance cost. The interest of 54. Therefore, we say 8% bond, 8% bond, interest on 8% bond, 54. Interest on 8% bond, 54. But the balance, this one will go to the balance sheet as our liability. It will go to the balance sheet as a liability. Therefore, let me see total interest expense. $39.34. $39.34. Then we get net interest. Net interest income, where I'm going to subtract 5485, 1551. That is my net. Then we come to non-interest, we add non-interest income. Non-interest income or operating incomes. Non-interest income or operating income, where we have fees, commission, and foreign exchange gain. Fees, commissions, and foreign exchange gain. And foreign exchange which is 1690. If I'm not wrong, 1690. 1690, and I believe that is the only other income we have. Therefore, you give me total income. Total incomes, we add 7641. 7641. Then we come to less non-interest expense, non-interest expense or operating expense. Non-interest expense or operating expense, it's just same term. Operating expense, where we have administrative expense. Administrative expense of how much? 2160. 2160. Then we have other operating. Other operating expense, which is 1163. Do we have anything else? No. We don't have anything else. We don't have anything else. Therefore, I get total. $33.23. $33.23 there. Then I come to get my profit before tax. Before tax, profit before tax there, which is 76. $43.18. Profit before tax comes to $43.18. $43.18. Then we come to less taxation. Less taxation here, we have deferred tax, current tax. Then we have deferred tax. Now, when we talk of taxation, when you check in note number 3, I believe you are checking in note number 3, it says, during the year ended that 1st March 2022, the current tax on profit was estimated at 890. Current tax was estimated at 890. Therefore, we put there 890. But kindly check in the trial balance. Check in the trial balance. When you check in the trial balance, it is showing us installment tax paid. Trial balance. Let me write here the word trial balance. Trial balance, so that you check. Trial balance, it is showing us installment tax paid. Therefore, it means that out of this 890, there is something small that we paid. Therefore, total tax was 890. We paid from the trial balance, we paid 360. 360. Therefore, the remaining, how much is the remaining? It means it will go to our balance sheet, 890 minus 360, 530. 530, it means that it will go to our balance sheet as a liability because during the year, our estimated tax was how much? 890. But we only paid 360. When you check in the trial balance, we paid 360. Therefore, it means the balance we got, but this total estimated tax cost will be an L. Cost will be an L. Then we go to deferred tax. Deferred tax, when you check in the trial balance, I have written here the trial balance. This is our trial balance. When you check there, we have deferred tax on 1st April 2021. as 370. But in note number 3, when we read note number 3, it says, during the year ended that 1st March 2022, the current tax on profits was estimated at 890 million. As at that 1st March 2022, the carrying amount of the net assets exceeded their tax base by 1.8 million. These carrying amounts do not include the effect on of the revaluation in note 2 above. The income tax rate applicable to Berda Bank Limited is 30%. Therefore, in that note, examiner wants us to calculate what we call deferred tax. Examiner wants us to calculate what we call deferred tax. Now, I want my good friend Ruth to tell me, how do we compute deferred tax? How do you calculate deferred tax? We say deferred tax equals to deferred tax equals to deferred tax equals to temporal difference times tax rate. Deferred tax equals to temporal difference times tax rate. Thank you very much, Ruth. If you can remember that, then I have confidence in you that you will do wonders in the exam. If you can remember that, deferred tax equals to temporal difference times tax rate. Thank you very much. Then, how do we get temporal difference? Can we remember how to get temporal difference? Yes, temporal difference equals to carrying amount of an asset minus tax base. Carrying amount minus tax base. Temporal difference equals to carrying amount minus tax base. Now, examiner in this note is saying that the carrying amount exceeded the tax base by 18. Therefore, which means our temporal difference equals to 1800 because the carrying amount exceeded the tax base by 18. The carrying amount exceeded the tax base by 18, which means we have the temporal difference of 18. But now examiner is continuing to say the carrying amount do not include the effect of revaluation in note number 2. Therefore, let's see the effect of revaluation. Effect of revaluation in note number 2. Revaluation in note number 2, we revalue the asset to 2,500 minus 1,850. Note number 2. Note number 2. What was the revaluation? What was the revaluation? What was the revaluation? It is 2,500 minus 1,850. 650. Revaluation is 650. Revaluation is 650. Therefore, if revaluation is 650, total temporal difference equals to 1,800 plus 650. Total, because we have not included that, I'm going to include. Therefore, it is 1,800 plus 650. I'm getting 2,450. 2,450. 2,450. Now, 2,450 times 30%. Times 30%, 735, 735, 735. Therefore, my deferred tax liability, deferred tax liability equals to 735. Deferred tax liability is 735. But remember, we say that how do we report the expense? How do we report the expense? We check in the movement of deferred tax. Therefore, we prepare deferred tax account to check in the movement. Deferred tax account to check the movement in deferred tax. To check the movement in deferred tax. Our balance carried down, brought down. When we started the year from the trial balance, we had 370. That was the opening deferred tax. Closing deferred tax balance carried down is 735. 735. 735. If you remember deferred tax very well, we say that what goes to P&L, we check in the movement. What was the opening balance? What is the closing balance? And also, if we have revaluation, we compute the tax effect on revaluation surplus. Tax effect on revaluation. Therefore, we say tax effect on revaluation. Tax effect on revaluation, which is 650 times 30%. Tax effect on revaluation. Tax effect on revaluation. Tax effect on revaluation, which is 650 times 0.3. 195. 195. Tax effect on revaluation is 195. Now, let me explain something. Remember here, listen very carefully, kindly, my good friends. Listen very carefully. Here, we just added revaluation because the examiner told us that it was not included in the temporal difference. But if the examiner did not tell us that it was included, then we could not have added. Listen very carefully. If the examiner told us that we already included, then we should not include. But at the end of the period, you are required to compute the tax effect on revaluation the same way Mwalimu is doing. You do the tax effect on revaluation. Tax effect on revaluation. Therefore, here I will take I'm getting 170. P and L 170. Therefore, that is our expense. Deferred tax expense is 170. Deferred tax expense is 170. Therefore, I come to my P and L and say 170 there. Deferred tax is 170. Therefore, I take 890 plus 170. 1060. 1060. Therefore, I less 3258. 3258. 3258 is my profit after tax. Okay. Profit after tax. 3258 is the profit after tax. 3258 is the profit after tax. We less dividend if we have dividend. Do we have dividend? Of course, we don't have dividend. Therefore, I come to add retained earnings brought down from the trial balance. Retained earnings brought down from the trial balance, which is 3623. 3623. I add, then I get retained earnings carried down. I get retained earnings carried down. $68.61. 68.81, sorry. That is my retained earnings carried down. Retained earnings carried down. Retained earnings carried down. Retained earnings carried down. That is the end of our P&L statement in a bank. Profit and loss statement in a bank. Profit and loss statement in a bank. That is how you prepare the statement of profit and loss in the bank. Any question? But even before you ask the question, let's have the health break of 5 minutes. When we come back, we do the balance sheet, then we are done. When we come back, we do the balance sheet of our bank. Therefore, let's have a health break of 5 minutes. Just a health break of 5 minutes. Thank you. Thank you very much. Health break of 5 minutes. The balance sheet of a bank, the balance sheet of a bank is that in a bank, assets, you don't list assets as non-current assets or current assets. You just list all the assets. But in the banking institution, you begin with the most liquid assets. You don't say these are non-current like in any other financial statement, non-current assets, current assets, no. You just say assets. Then you list all of them, but you begin with the most liquid assets. You begin with the most liquid assets. What are the most liquid assets in the banking institution? The most liquid assets are, for example, cash, in the central bank. Those are the most liquid. Therefore, let's use our question to see how you prepare the balance sheet of a bank quickly. How do you prepare the balance sheet of a bank? Therefore, we say Belga Limited, Belga Bank Limited, sorry, Belga Bank Limited, statement of financial position as at 31st March 2022. 2022 as at 31st March 2022. You underline very well and give me the currency shillings in millions. You give me the currency shillings in millions. Therefore, in a bank, you just list the assets. We just say assets. Assets there. You just say assets there. Under assets, we have cash and balance with central bank. Cash and balance with central bank. That is the most liquid, 4046. We go to money on demand and short-term deposit. Money on demand and short-term deposit. And short-term deposit, 2150. 2150, you just list them. Deposit with other bank. With other bank. Deposit with other bank. Investment in government securities. Government securities. Government securities. We have loans and advances. Loans and advances. Loans and advances. Now, listen carefully here something. Listen something. For example, in a question, listen. For example, in a question, examiner will tell you that provision for loss allowance. Provision for loss allowance was maybe 2%. Or for example, it was 2%. Provision for loss allowance was 2%. Where do you provide for loss allowance? Loans and what? Advances. Like for example, in this question, in the other question, examiner, if he tells us provision for loss allowance was 2%, it will be 8144 times 2%. Whatever you get, let me assume 10. But whatever you get, I'm assuming 10. Don't ask me, Marim, it's not 10. I'm assuming it is 10. For example, if it was 10, provision for loss allowance, this one goes to P&L as an expense. It goes to P&L as an expense. And also when I'm reporting here, I will take 8144 minus 10. Don't ask me, it's not 10. I'm just assuming to explain our concept here. Therefore, 8144 minus 10, that is what you do. If there was an additional information, examiner is telling you provision for loss allowance was 2% or 5% or whichever percentage. That is how you do it. But in this question, examiner did not tell us that provision for loss allowance was there. Therefore, we go to other receivables, which is 765. Then we have investment in equity instruments, investment in equity instruments. No, other receivables is 24. Other receivables is 2493. Equity instrument is 765 there. Then we have intangible assets. Of which it is 4986. 4986. We are just listing the assets from the trial balance, nothing else. The only thing you need to know is that you list them from the most liquid to the least. We come to property, plant, and equipments, PPE. Now, when we come to PPE, I'm going to take 7416. I add 650. The revaluation, we add the revaluation 650. Remember, we revalued the asset 25 minus 1850. There was 650. And we had not accounted for that revaluation. Therefore, we account for it. That comes to 74. $80.86. 80.66 there. 80.66, we have accounted for the revaluation. When you revalue the asset, the moment you revalue the asset, you debit asset account. You credit revaluation reserve, therefore, which means we are going to create revaluation reserve account. We create what we call revaluation reserve account. Then, I think we are done with the assets. Therefore, you give me total assets there. Total assets. You give me total assets. I'm not going to add it for you, but you will add them yourself. Then we come to capital and reserves. Capital and reserves. Capital and reserves there. Here we have ordinary share capital. Ordinary share capital, we are told it is 4,400. 4,400. Share premium. Share premium, 2,500. 2,500. Deposit protection reserve. Deposit protection reserve. 5,000. Then we report retained earnings. Retained earnings. What was our retained earnings? Mwalimu removed. I wrapped mine. I know yours, you have not wrapped it, you still have in the books. Retained earnings in our income statement. What was our retained earnings? From our income statement, total retained earnings carried down. 68.81. Thank you very much. 68.81. 68.81. Then we have revaluation. We come to report the valuation, which was 650, but remember we computed deferred tax on it of 195. We come to compute revaluation. Revaluation was 650, but there was tax effect on revaluation surplus, which was 195 in our deferred tax account. Therefore, we take 650 minus 195, we get 455. 455 as our revaluation, as our revaluation, as our revaluation, as our revaluation, as our revaluation. Then we go to liabilities. Also liabilities, we are just going to list them as liabilities. We are just going to list them as liabilities. Therefore, we say liabilities. We say liabilities, where we have under liabilities, we can start with customer deposit. Customer deposit. Customer deposit 7065. Deposit from other banks. Deposit from other banks. 3324. We have long-term borrowings. Long-term borrowings. Long-term borrowings 5660. Then also we had 8% bond. 8% bond. We had 8% bond. 468, if I remember from our amortization schedule. From our amortization schedule, we did 8% bond. We got at the end 468, if I remember. Then we have other payables. Other payables. Other payables, which is 2717. 2717 as other payables. Other payables. Other payables. Then we have current deferred tax. We have deferred. Deferred tax was 735. What we computed, we said it's a liability, 735. If you remember, we computed deferred tax. What else? What else? Who can see anything else? Who can see? Yes, current tax. Current tax. Current tax. If I remember current tax, it was 890 minus 360. We got 530. Current tax. Current tax. Then you give me total. If there is nothing else, total equity and liabilities. Total equity. Make sure that you add so that you give Mwalimu correct figures there. Make sure that you are adding so that we get correct figures. If our bank statement balances or not, assets and liabilities, if they balance. If they don't balance, we reconcile where is the problem. But for now, do it quickly. Do it quickly. I'm giving you 5 minutes. Do it quickly. 5 minutes so that we go to something else. That is how you prepare financial statement or the balance sheet of a bank. The only challenge comes on assets. You don't mention current, non-current. You just list them the way we have done. But in a banking institution, you start with the most liquid assets there, the most liquid assets. Therefore, That is the end of our topic, financial statement for banks. Therefore, we go to the next item, which is financial statement for insurance company. Financial statement for an insurance company. If there is no question, we just go straight to that item, financial statement for an insurance company. Financial statement for an insurance company. Insurance fund, that is IFRS 4. IFRS 4. Remember, everything we are doing according to the standard. Therefore, this one we discuss it under IFRS 4. Remember, in the insurance companies, we have two standards that deal with insurance companies. We have IFRS 4, which we are going to compute the financial statement. Then at the same time, we have IFRS 17, which deals with insurance contracts. Therefore, sometimes you can find is IFRS 17, then you may think that maybe we did not do enough. No, we are doing according to what KASNEB requires, financial statement of an insurance company. But if you want more about insurance contracts, you go to IFRS 17, where you discuss it. Now, first we need to know what is an insurance. What is an insurance? What is an insurance? That is the beginning point. What is an insurance? You say an insurance is a contract. You say an insurance is a contract. You say an insurance is a contract in which one party, in bracket insurer, a contract in which one party, in bracket, you say insurer, agrees to compensate another party, in bracket insured, agrees to compensate another party, in bracket the insured, in the event the risk occurs, It's a contract in which one party, the insurer, agrees to compensate another party, the insured, in the event the risk occurs. Now, types of insurance. Here we have what we call number one, life assurance. Number two, general insurance or property. General or property insurance. General or property insurance. Those are the two types of insurance that we have, either life assurance or general insurance. Then we want to look at the terms we are going to use in insurance. Those are the peculiar terms we are going to use in our financial statement. And like in banks, we saw what are the terms we use. Therefore, we want also to see in insurance, which are the terms are we going to use. Number one, premium. Number one is the premium. Premium, you say, Premium, you say, this is the amount. This is the amount. This is the amount contributable by the insured. This is the amount contributable by the insured to the insurance company. This is the amount contributable by the insured to the insurance company. In bracket, you say is the revenue of an insurance revenue. In bracket, you say is the revenue. That is where the insurance company derives its revenue from the premiums. Therefore, for you, if you go to take insurance like with any insurance like Jubilee Insurance, Pan-African Insurance, or Robertson Insurance, therefore, when the moment you go there, what they will ask, how much are you willing to pay each month or each year? That is the premium. Therefore, that is what you contribute, and it becomes the revenue to the insurance company. Number 2 item is the claim. We are going to use the claim in our financial statement. Number 2, claim. Number 2 is the claim. Claim, we say, claim, the amount payable to the insured party upon the occurrence of the risk. Amount payable to the insured party, amount payable to the insured party upon the occurrence of the risk. Amount payable to the insured party upon the occurrence of the risk. That is the claim. Number 3 is claim. Claim intimated. Claim intimated and outstanding. Number 3 is the claim intimated and outstanding. Claim intimated and outstanding. And outstanding, you say, this represents the claim. This represents the claim which has been approved for payment. This represents the claim which has been approved for payment, but has not been paid by the insurance company. This represents the claim that has been approved for payment, but has not been paid by the insurance company. This represents the claim that has been approved for payment, but has not been paid by the insurance company. Has not been paid by the insurance company. Remember what I'm saying. For example, you insured your car against accident. Then by bad luck, the accident has occurred. Now, after the accident, the actuaries have come and have assessed the situation and have approved that this needs to be paid. Therefore, if it has been approved for payment, but you will find that in the insurance company itself has not paid the money out. The insurance company has not paid the money out. Therefore, it is still pending. That amount is still pending. Therefore, we call it the claim intimated and outstanding. Claim intimated and outstanding. Next, number 4. Number 4 is reserve. Reserve for an expired risk. An expired risk. Or we call it an earned premium. An earned premium. Reserve for an expired risk, or we call it an earned what? Premium. Reserve for an expired risk, or we call it an earned what? Premium. Reserve for an expired risk, or we call it an earned premium. You say, this is the prospective assessment. This is the prospective assessment of the amount. This is the prospective assessment of the amount that needs to be set aside. Prospective assessment of the amount that needs to be set aside. In order to provide for claims in order to provide for claims, and costs, claims and costs, that will result out of an expired future periods. That will result out of an expired future periods. Out of an expired future periods. Out of an expired future periods. This is computed as a percentage. This is computed as a percentage of net premiums. This is computed as a percentage of net premiums. This is computed as a percentage of net premiums and recognized as a liability in the balance sheet. This is computed as a percentage of net premiums, and recognized as a liability in the balance sheet, This is what Malim is saying. Remember, for you, you are paying the premium. Listen very carefully here. You are paying the premium. And when you pay the premium, you expect that when the risk occurs, you will be compensated. You expect compensation. Therefore, for the insurance company to compensate you, they will compensate you out of this premium. They will compensate you out of the premium. And remember, we say that the premium is the revenue of an insurance company. Therefore, for example, you have contributed 1 million. Let me assume you have contributed 1 million to an insurance company. And now the insurance company has taken those premiums as revenue. But out of that, they can decide to set aside like 500,000, so that in the event the risk occurs, they can compensate. Therefore, out of 1 million, we are setting aside 500,000 so that it caters for any eventuality that may arise. If you go to claim, you will be paid. Therefore, 1 million is not all the revenue, because they must set aside some amount. That amount that is set aside, we call it reserve for an expired risk or an earned premium. Let's go to the next term. We finish the terms so that we look at the question. Number 5 is commission ceded. Number 5 is the commission ceded. Then you say it is the commission receivable. It is the commission receivable from reinsurance premiums paid. It is the commission receivable from reinsurance premiums paid. Reinsurance premiums paid. Commission receivable from reinsurance premiums paid. Then number 6 is the commission accepted. Commission accepted is the commission payable. Is the commission payable to the reinsurance firm. It is computed as a percentage of reinsurance premiums reinsurance premiums received as a percentage of reinsurance premiums received as a percentage of reinsurance premiums received. It is computed as a percentage of reinsurance premiums received. Let me explain the two terms. Let us understand the meaning of the two terms: commission ceded and commission accepted. Commission ceded and commission accepted. Let us understand them. Now here we have my good friend Ruth here. My good friend Ruth here. Ruth decides to go to an insurance company A. Ruth decides to go to an insurance company A. When you go to an insurance company A, you are going to take there your policy. Therefore, you pay the premiums. You pay the premiums to insurance company. Ruth is paying the insurance premium. This is my good friend Ruth. You are paying the insurance premiums to the insurance company A. But remember that your policy is very huge. That risk that you are taking to insurance company A is very huge. Like now, the government is building what we call affordable housing. It's a very huge project. Therefore, if you decide to insure them, one insurance company cannot hold. Therefore, you, this is affordable housing. Affordable, let me write the word affordable housing. This is the affordable housing you are taking to insurance company A. But because insurance company A knows very well that if something happens, it cannot compensate Ruth. It cannot compensate Ruth alone. Therefore, it goes to another insurance company B. It goes to another insurance company B. And when you go to insurance company B, it does what we call reinsurance. Reinsurance. It is called reinsurance. You also extend the risk to another insurance company. You do what we call reinsurance. Now, when you take the risk there, then you also give them the premiums. You also give them the premiums. You also give them the premiums. We call them reinsurance premium. Reinsurance premium. You give them the premium. We call them reinsurance premium. Therefore, when company B receive these premiums, they will bring back a hand and pay what we call a commission. Because you are giving them business, they give them what we call a commission. They give you what we call a commission. A commission. They give you what we call a commission. This commission that company A is receiving, we call it commission ceded. Commission ceded. It is income to insurance company A, because it's receiving out of the insurance. Out of the insurance, you get the commission there. Company B will pay the commission. Company B will pay the commission. Company B will pay the commission to company A for giving them business. For giving them business. Remember, you are just in the office seated, then somebody comes with the business. That is commission ceded. Let me show you commission accepted. Commission accepted. Now we have another insurance company C. We have another insurance company C there. We have another insurance company C there. This insurance company C also has a very huge business. A very huge business that it cannot compensate alone. It has a very huge business that it cannot compensate alone. Therefore, it goes to company A. It goes to company A. Then it tells company A, let me share with you this business, this insurance. Therefore, when it goes to company A, it will pay company A reinsurance premium. It will pay company A reinsurance premium. Now, when company A receives the reinsurance premium, they will also pay a commission. They pay a commission. They pay a commission. Company A will pay the commission, because it has received the business from company C. Then that commission that company A is paying, we call it commission accepted. Commission accepted. We call it commission accepted. This is an expense to company A. This is an expense to company A. This is an income. The first one is an income to company A. The second one is an expense to company A. I'm assuming we are preparing the financial statement of company A. That's why I'm using, it is taking out business. It's also receiving business from other companies, Therefore, that is what we call commission ceded and commission accepted. Commission ceded is an income, commission accepted is an expense, Therefore, those are the terms that we are going to use in our financial statement. Let us look at the financial statements of an insurance company. Financial statement, we have number one, revenue account. Number one is the revenue account. Number two is the profit and loss statement as usual. Then number three is the statement of financial position as usual. Those are the financial statements of an insurance company. Therefore, having said that, we are stopping there our lesson today. We meet on Monday at 5 p.m. God willing, 5 p.m. on Monday, as we look at the questions and everything on insurance. We meet on Monday as we discuss more on insurance. Then we shall be done with it. Therefore, for today, be blessed. Let's meet on Monday.